When it comes to the investment property, most investors leave thousands of dollars on the table every single year. And it is because they don't know what they are allowed to claim on tax. Here is the thing. The ATO doesn't send you a reminder about what you have missed. They are only interested in what you have overclaimed. I am Ash from ClearTax, and we have been working closely with property investors for years. The reality is, I've seen people missed out on deductions worth thousands of dollars simply because they don't know these deductions existed or assumed they couldn't claim for them. So in the next few minutes, I'm going to walk you through the 10 most powerful tax deductions Australian property investors can legally claim in 2026. And few of these are often overlooked by even the most experienced investors. Let's get into it. Now, before we get started, I need to make something clear. This isn't about pushing boundaries or finding loopholes in the tax system. It's about claiming what you are legally entitled to. Your job is to understand the rules, keep proper records, and claim every legitimate deduction available to you. When you do that correctly, the 10 deductions we are about to take a look at can easily save you 5 to 10,000, even 15,000 or more each year. So let's go through them one by one, starting with the biggest. The first and usually the biggest deduction for most investors is the loan interest. If you have borrowed money to purchase or renovate your investment property, the interest on that loan is fully deductible. But here is the critical part that catches people out. You can only claim the loan interest on the investment proportion. Say you took out 500,000 loan to buy an investment property. That interest is deductible. But if you then redraw 50,000 from the loan to buy a new car for personal use, the interest on that 50,000 proportion is no longer deductible. The ATO is very clear on this. The loan amount must be used to produce assessable income. Personal redraw don't count. Also, if you have split loan, where part is for investment and part is for your own home, you need to apportion the interest correctly. So, how do you combat this? Keep your loans separate, if possible. It makes record keeping far simpler and reduce your audit risk. Number 2 is depreciation, which is actually one of the most misunderstood, most powerful deductions available to property investors. Depreciation is the decline in value of the building and its assets over time due to wear and tear. It's what we call non-cash deduction, meaning you are allowed to claim it even though you haven't actually spent any money. There are two types of depreciation you can claim on an investment property. Number 1, Division 43, otherwise known as Capital Works Deduction. This covers the structural element of the building itself for things like walls, floors, roofs, and fixed items like built-in wardrobes. You can claim 2.5% of the construction cost per year for 40 years. But for properties where construction commenced after 15 September 1987. Number 2, Division 40 or Plant and Equipment Depreciation. This covers removable assets like carpet, blinds, appliances, air conditioning units, and hot water systems. These depreciate at different rates depending on their effective life. But here is where you need to be careful. If you buy an established residential property that's not brand new, you can only claim plant and equipment depreciation on items you purchased yourself. So you can't claim depreciation on items the previous owner has installed. Number 3 is repairs, maintenance, and improvement. This is where investors often get confused. Repairs and maintenance are deductible, but improvements are not. What's the difference? Well, repairs restore something that's original condition, while maintenance keeps something in a good working order, and improvements make something better than it was. Even though you can't directly claim these, you can claim capital improvements. These are assets that depreciate over time. Let me give you some examples. Deductible repairs include repainting a room that's been damaged, fixing a broken fence, replacing a broken tile with the similar ones, or repairing a leaking roof. And all consider immediate tax deductions. But capital improvements like renovating a bathroom, adding a deck, replacing an old kitchen with an upgraded one, or adding a carport, all needs to be claimed later down the track because they must be depreciated over time. Now, here's the timing issue that catches people out. If you do repairs before the property is first rented out, or as a part of initial renovations, before it starts generating income for you as an investor, those costs are considered as capital expenses and must be depreciated. You can only claim immediate deductions for repairs that occur after the property is already being used to earn rental income. The timing and the context are important here. Number 4 is the property management, and is pretty straightforward. If you use a property manager to handle tenant relations, rent collection, inspections, maintenance, coordinations, their fees are fully deductible in the year you pay them. Typically, property management fees range from 5 to 8% of the rental income, plus letting fee when your new tenants moves in, and all these costs are claimable. Even if you self-manage, you can still claim related expenses like advertising for tenants, but you can't pay yourself a management fee. Number 5 is the council rates. As an investor, you can claim all council rates, but only if you are one who is paying them. In most states, landlords pay council rates and water services charges, while tenants typically pay for water usage. So you can claim what you pay, but not what gets passed on to the tenant. If your property is vacant, you can still claim these costs for the period it's genuinely available for rent. Number 6 is insurance premiums. Insurance costs can add up, so it's always nice to know that any insurance you take for an investment property is deductible. This includes landlord insurance, building insurance, content insurance if you are renting the property out as furnished. Even insurance for the loss of rental income during vacancy period is claimable. A handy tip here is to make sure you are not claiming own home if you have multiple properties. Only the investment property premiums are deductible. Number 7, borrowing cost. When you take out a loan for your investment property, there are various upfront costs involved, and these are called borrowing cost. They are deductible, but the rules vary depending on the amount. Borrowing cost includes loan establishment fee, lender mortgage insurance, also known as LMI, mortgage broker fees, title search fees, stamp duty on a mortgage not on the property, and the valuation fee required by the lender. If the total borrowing costs are $100 or less, you can claim them immediately in full. And here's the best bit. If you refinance your investment loan, you can claim the remaining borrowing cost from the original loan in the same year. Plus, you can start claiming the new borrowing cost from the refinance loan. Number 8, strata fees. If you own an apartment, townhouse, or any property in strata scheme, your strata fees are generally deductible. But there's a distinction. Ongoing administrative fee for maintenance, insurance, and common area upkeep are immediately deductible. If your strata scheme has a capital works fund or special levy for major improvements like replacing a roof or renovating a lobby, these are capital expenses and must be depreciated, meaning they're not immediately deductible. Always check your strata statement carefully, separate the two types of charges. Number 9, utilities during vacancy. If your property is vacant and genuinely available for rent, you can claim the utilities you pay during the period, including electricity, gas, and water. The keyword here is genuinely available. You can't claim these expenses if you are renovating the property or using it for yourself. Once a tenant moves in and they are responsible for utilities, you can no longer claim them. You can only claim what you are paying out of pocket. And that brings us to number 10, which is professional services. Because these services are legitimate business expenses associated with your earning rental income, they are fully deductible. Deductible expenses in this category includes quantity surveyor fees for preparing a depreciation schedule, tax agent fee for preparing your rental property schedule and tax return, legal fees for lease agreements or evicting a tenant, and accountant fee for tax advice related to your property. One thing to add here is that legal fees related to purchasing the property is not immediately deductible, but they are added to your property cost base. This means the legal fees only reduce your capital gains tax when you sell. So there you have it. These are 10 tax deductions will help you as a property investor. Claim more come tax time. But here is the reality. Tax law is complex and everyone's situation is different. what's deductible for one investor might not be for another, depending on how you have structured your property ownership and your specific circumstances. So, it's always important to work with a qualified tax professional who specialize in property investments. They will make sure you are claiming everything you are entitled to while staying 100% ATO compliant. And if you want help maximizing your property tax deductions while staying on the right side of the ATO, reach out to our team. We specialize in helping property investors like you to structure their finances correctly from day one. Thank you for watching. I'll see you in the next one.